Hey everybody, how's it going? Welcome to Stock Trading Pro. Tonight we have a special guest. We're going to talk about stock options tonight, something that we don't normally do. We kind of stay away from what we're not good at and dive into what we normally are on top of every day, which is just straight up trading stocks. But we get a ton of requests for conversations around what do I do with order flow with options doing the same exact thing. And John actually, we looked long and hard and far to find somebody that we couldn't wait to work with, somebody who is in the same groove as we are, so to speak, with top-down analysis. And we're going to keep it super casual tonight. We're going to keep it about questions that you have. So if everybody could just do me a favor, type into the chat, confirm that you can see the screen, hear the audio. We're going to keep it beginner level tonight. I'm sure John can handle any question, but we want to make sure that everybody on the call tonight can really participate and get some value out of the call as well. The recording obviously will be here on YouTube. Everybody can watch the replay whenever you want. So first thing I want to do, though, is I want to introduce John. That's a big deal because obviously we want to let everybody know who we're speaking to. Let's see, Gardner, welcome tonight. I want to make sure I say everybody's name correctly. Spartan EDW. All right. So first, we're going to do a little bit of an intro on John here. And basically, John is like myself. He's a New Yorker. Love to see New Yorkers in here, right?
Native New Yorker.
Native New Yorker, and soon to be maybe not a native New Yorker anymore.
That's true. I'm here in sunny Florida.
Fordham University. So John's got a lot of credentials here, but I think that probably the simplest way to do it is just to let you speak about yourself. I know you've been a long tenured options trader as well as teaching it yourself, which is obviously why we're here tonight. So if you can give us a little bit of your own flavor on your background as far as the markets and options trading as well.
Yeah, absolutely. So, thanks for letting me hop on here, Pete. So basically, my basic background for 20 years was in institutional trading. So that is where I got my background in not just options trading, but global equity trading as well across different regions, not just in the US, but all over Europe and Asia as well. So we had global portfolios, and a lot of it was basically had to be hedged. So a lot of the early options trading that I did had to do with, basically hedging strategies. So that's where I got used to how effective they could be and how active they could be and stuff like that. So that's how I started. But then later on, once I started working for myself and my own capital and stuff like that, I basically traded options on my own. And that was a much big transition. That's where I had to kind of learn the top-down approach. I had to learn the strategy of when to pick which option and when. The first couple of years was tough because just like most traders, I just knew how to buy calls and puts, right? So I would kind of just be really basic, and I tried to follow some plans here and there, but I didn't find it to be very successful. I think the key to real option trading is to know what tool to use and when. And I think that's what a lot of people, don't know how to do. And you could actually have a really good idea or be bullish on a stock or bearish on a stock and actually lose money because your timing could be off, or you could just pick the wrong option strategy. Because options, unlike stocks, have an expiration date. So if you pick the wrong strike price, the wrong expiration date, it could prove pretty tragic, even if you actually have a legitimately good idea that would work under normal circumstances. So that is what I managed to develop over the last 5 or 6 years, trading on my own. I work full time. I do risk management for prop desks. I've coached not just individual traders, but I've coached entire trading desks on how to manage their risk and how to set up their charts and stuff like that, and what option strategies are the most effective. So I have a pretty broad background when it comes to not just trading, but also risk management and how to really have an overall good portfolio trading strategy. Because when you trade options, it's really about having a basket of stocks, right? Both bullish and bearish. And essentially you're holding things for sometimes days, sometimes weeks. It's a little bit different than day trading in the sense where you're in and out of things in a couple of minutes. There's very few strategies that work with options like that. It's more of usually you trade options for several days or several weeks. So you have to have a really good strategy. And that's
when you're you had mentioned before buying calls versus puts. Do you think one of the biggest mistakes people make is they either buy too far out of the money or they don't buy enough time?
I think 9 times out of 10 people complain they run out of time. So
Oh, really?
what happens is sometimes they look at a chart, let's say it's in an uptrend, right? Typical stock that's in an uptrend. And then all of a sudden the market decides to not cooperate with you. So you know from doing top-down analysis that the market has 60% to do with the movement of a stock at any given time, right? It doesn't really matter what the stock is, unless there's news and unless there's specific news. But under normal circumstances, the direction of the market really drives the direction of an individual stock at any given time. So the problem is you could be bullish on a stock, and if the market or the sector doesn't cooperate with you, it could play the sideways game on you for a couple of weeks. Now, if you're trading a stock, that's okay. You're not losing any money, right? But if you're trading an option, you are losing money. You're losing money every single day because of something called theta decay, which we talk about in our classes, obviously. And that is your biggest enemy as a long option trader. When you're buying an option, whether it's a call or a put, your biggest enemy is time. So basically, that is 9 times out of 10 the biggest problem. Also, picking something that's out of the money tends to be a problem too. A lot of options traders, they look at the prices on an option chart and they notice that the in the money or the at the money options are more expensive because they have intrinsic value attached to them or they're closer to current price. So a novice option trader will be like, well, I could buy 10 contracts of this one as opposed to 1 contract of that one. So they'll go ahead and they'll load up on out of the money options and lose all their money. So that's also a very common mistake that a lot of options.
I've seen some chat rooms call those lotto trades, which doesn't make any sense to me at all. I'd rather have consistent and probability on my side than hoping I hit the lotto. That just, from a probability perspective, it doesn't make any sense. But I think that is why a lot of people mistakenly trade options, is probably for the biggest reasons are they can afford to buy the options contract, but have no idea whether it's expensive, even if they can afford it. Maybe you can get into the little bit of volatility and premium and that kind of stuff.
Absolutely. So, obviously, when it comes to volatility, it's just kind of like when you're picking an option strategy, volatility is a very important gauge on your car, so to speak. In a high volatility environment, which we define in our classes, where we talk about what exactly is a high volatility environment, you don't necessarily want to be a buyer of an option at all. You might want to be a seller of an option, in which case you're letting time work in your favor. When you're a net seller, you're actually taking in premium versus paying a premium. And you want to be a seller of an option when vol is high. And obviously when vol is either, moderate to low, you want to be an option buyer. So it's really important to not just understand what the stock is doing that you're trading when you're doing an option. You also have to understand what's going on in the overall market. So there's a little extra steps you have to take. You have to look at volatility of the underlying stock, which is called the implied volatility. But you also have to look at the volatility of the overall stock market. So, and then kind of compare that to what the stock has done historically and make a judgment call. And that's one of the things we stress in our classes is, what strategy to use and when, what tool to use and when. And that's really what gives you an edge. You need an edge when it comes to trading, no matter what you decide to trade. Obviously, picking the right stocks, the right sectors, the right time is challenging enough. With options, the challenge also lies in what strategy to use. And that's the key.
Are you looking at, I'm going to talk from a beginner perspective because I want to make sure that everybody on the call has the most benefit from watching this. Are you looking at the option first or the stock first?
I always look at the stock first. So my starting point is much like you. I'll look at the market. I'll make a call on, am I bullish or am I bearish? What's going on this week? What can I expect? Obviously, you can make adjustments during the week as things unfold. But then I look at each individual sectors. I pick my bulls and my bears. I decide how bullish or how bearish I want to be. And then what I'll do is I will start using different screening tools and different screening methods to find the best opportunities. So I have certain rules that I put in place. Out of a universe of 10,000 stocks, I try to whittle it down to 10, which is something that I do on a weekly basis. And then I put together my watch list on a weekly basis. It usually changes week to week. There'll be some repeats here and there. And then I'll start looking at the option prices. So Obviously, some options have monthly expirations. Some have weeklies. So I start putting together strategies that make sense based on what I want to do, based on volatility, based on what my target might be for the stock. I might have multiple targets for a stock. I might think it's going to reach one area of resistance, and then maybe I'll think it might break through to another area. And that's what I'll set up strategies for that as well.
If somebody never traded options before and the first thing they're saying to you is, I have a $5,000 account. I think what's interesting is you just mentioned that you're only looking at 10 stocks. You're whittling all the way down to 10 before you even look at the strategy. I think that a lot of people that we see coming into our community, they use our strategy of order flow, but then they're using it all over the place. They're not dialed in. Most of the professional options traders that I know trade the same stocks or ETFs, honestly, over and over and over again each month.
Yep. Yeah, there's absolutely nothing wrong with just picking individual ETFs or actually the broad market. So to answer your question, if somebody had, let's say, a smaller account, like $5,000, I wouldn't even go necessarily drill down to individual stocks. I would go to SPY or QQQ to start there. And I would actually execute multi-leg strategies using SPY and QQQ. So I get familiar with not necessarily the different names, but with the strategies. That's what's most important, because that's gonna carry down no matter whether you're trading the broad market or whether you're trading a sector or whether you're trading an individual stock. So if someone has a smaller account, learn obviously when you should be buying puts and calls, but also learn some of the double leg strategies like vertical spreads, diagonal spreads, stuff like that, credit spreads, the stuff that we cover in our class.
Can you explain the difference between a credit spread and a debit spread?
Absolutely. So a debit spread you have to pay, right? That's why it's a debit. So that's basically a straight call and a straight put. Now, if you do something like a vertical debit spread, that means that you have something called your anchor leg. So your anchor leg is always going to be your main money leg, the leg that you care about, so to speak. That's going to be the leg that you're bullish on, let's say, if you buy a call option. But sometimes what you want to do, if volatility is, let's say, somewhat high, maybe not extremely high, but somewhat high, you might want to sell a call against that security. And we talk about that in our class too, how to do that. So that actually lowers the cost of your trade, because you have a debit trade, which is your expensive anchor leg, which is the main trade you're trying to do. You're bullish. But then what you're doing is you're essentially selling something against it. And what that does is it lowers your cost, but it actually caps your gains. So that's kind of the trade-off that you have, okay? Now, there are ways to eliminate capping your gains at certain times, which is helpful as well. But either way, without complicating things too much, net, when you have that two-leg strategy, you're still paying a debit. Like if you add those two together, you're still paying. So that's a debit strategy. So in a debit strategy, time is against you, right? If you net the two out, time is still your enemy. And you basically, you want to take advantage of movement in stock and volatility. A credit spread is the opposite in the sense that your main leg is your net seller of an option. So now when you're a seller of an option, you have an obligation. You don't have a right to do something. You have an obligation to either receive shares or deliver shares out. Now, in order to lower that risk, what you can do then is buy an out-of-the-money debit trade. So that, again, if you add those two together, now you're a net credit trader. So the difference between a debit trade and a credit trade is what you're paying. A debit trade you are paying, and a credit trade you are receiving. And you're just basically running out the clock. When you're a credit trader, you have time working on your side as opposed to working against you. And ideally, in a perfect world, you want to be a credit trader in a high volatility environment, and you want the volatility to decrease as the time is melting away. And that allows you to profit from a decrease in volatility, and it allows you to profit from the passage of time. And that's the difference between debit and credit, essentially. Most people are one or the other. They have a bias, which is also a very bad thing to do. I'm actually coaching some traders in our classes now, and they're credit biased. They love the idea of being able to just sit and collect a premium. You know what I mean? Kind of like an insurance company collects a premium when you when you have a car insurance. They just sit back and collect a paycheck as long as you don't get into a car accident. It's kind of the same concept. That's why they use the word premium. So basically, I'm trying to get them out of the habit of just always doing one thing, because when volatility is low, it doesn't make sense to do any of those trades. And you're not getting paid to take on that extra risk. So
right.
you really got to use both tools, both sides, either debit or credit. So strategy selection with options is extremely important.
So just going to answer, I'm going to throw a couple of questions in here. John Robert has a question.
So it says here, Robert, what about buying an option at the strike price of the stock's target price? So a stock is trading at 20. I mean, that's definitely a strategy a lot of traders use. But again, what you're essentially doing is it's almost like a gamble. You're buying an out of the money call with the idea that it's going to reach that target. So a lot of traders do that, but I'm not a big fan of that for a couple of reasons. Number one, you have a lower probability trade, which I don't like. That's number one. And number two, time is not on your side, and you're basically, you have to be perfectly correct in order to succeed in a trade like that. I like being sort of right and making money most of the time. That's like the main difference. When you pick an at the money strike, for instance, you're picking the strike price that has the highest possibility of benefiting from vega or volatility. So the stock price, the at the money strike price has the highest vega, which you want when you want an acceleration of stock price movement. So I'm a big fan of at the money. I know a lot of traders like to play around with picking a target and using that as their strike price. Not a fan, only because it's a lower probability trade.
That's interesting. Okay. It's so interesting when you start getting into different, deeper into becoming a trader. When we all first start trading, whether it's stocks or options, we're like, we just want to make money. But then as you gain more experience, the focus now shifts more to consistency and the likelihood of making money, or as you're wording it there, probability. I think it's very interesting. You can actually, and this is nothing on Robert, that was a great question, but you can always tell where somebody is in their trader journey based on the question. Are they talking about risk first, or are they talking about making money first? Are they talking about probability or how much they could make? It's kind of fun to do that, because then you can easily not have a rebuttal to that, but just give a different perspective like you just did.
The upside to what Robert suggested, right? If you're perfectly correct, if it actually reaches that target in the allotted time that you choose, right, you're going to make a lot of money. Or because you'll probably be able to afford more contracts. So that's the upside. So it's a low probability, high reward, high risk trade. And if you're okay with that, that's on you. Me, I like to be sort of kind of right. I'm a horseshoes and hand grenades kind of guy. That's just my style.
Okay. I'm going to bring more questions in. Everybody who's watching this live, feel free to post questions in there. I'd be more than happy to get into them. Let's see. Michael asking about the Greeks.
So the Greeks are kind of like the gauges on your car. You obviously, depending on, that's a great question, but it's very hard to answer because there are so many ways to choose Greeks depending on what strategy you're using, right? So I want you to just think of Greeks as like if you're driving along the road, they don't necessarily control your car, but they tell you what to do. And that's kind of how the Greeks work. So Delta tells you, obviously the price movement based on a dollar move in the stock price. It's also kind of a rough probability gauge. Theta is obviously time to gauge. So you know how much money you're losing every day just based on holding that option. That's a very important gauge to know. And Vega tells you percentage volatility. So a 1% move in volatility, it shows you the dollar move in the underlying option. So, these are all things that you kind of have to be aware of. And you have to know where they're at in order to pick the right strategy.
Okay. I want to go back on something you had mentioned before about debit spread. If we're buying, let's just say we're buying a straight up call, which I think most people are familiar with doing, where if it's going up, they're buying a call. If it's going down, they're buying a put. If let's just say, for argument's sake, that call costs $500, just for argument's sake. So the reason we're selling the out of money call is to bring that cost down from, let's say, 500 to 200, we're capping
Mhm.
the upside, but it's costing us less to get into the position. Is that correct?
That's exactly it. So what you're essentially doing is you're going from 500. Let's say you sell an out of the money call at a target that you don't think that individual stock is going to reach. You obviously don't want to pick something too close because then you're leaving money on the table. So you have to pick, and that's where delta comes in. You look at delta then as kind of like a probability measure, so you could kind of look at the chart, come up with a target, and then figure out what that number is, what that strike price might be, and then see what that delta is, see what the market's telling you,
So the delta is the odds of it hitting the one you sell and the time.
Well, delta is roughly, it's a measure of money movement, but it also measures the rough probability of something expiring in the money.
That's what I meant. You worded it better.
So if something has a delta of 20, it has an 80% probability of expiring not in the money. It's not a probability of making money though. I don't want to make that mistake. It's a probability of just in the money.
Okay.
So basically you want something with a low delta then obviously, because you don't want to hit it. You want it to expire worthless. That's the whole point. And you just want to lower the cost of your trade.
So the reason I brought that up is, again, we have a lot of new members or new people on the call, is you think about the allocation of capital and how a lot of people try from the start to think about how much they could make versus how much can I allocate to that one position. So in other words, instead of buying a bunch of out of the money calls, spending $1,000, just as an example, if you know that that spread has a high probability, we'll stick to probability as the key word here, and you like that one setup, but then you do that same setup 3 times. Now you're putting up $600. It's a limited upside, but you put together a good trade.
But it's a higher probability.
Higher probability, exactly. The point I'm trying to get across here is there's so many nuances that go into a profitable options trade as opposed to I just want to be a buyer or seller.
Yeah. No, as you gain more experience trading, you'll realize, it's all about risk management and allocating capital appropriately. You know what I mean? And that's the key. If you have $1,000 to spend, I'd much rather spend it on an at the money vertical spread, let's say, that has a high probability outcome as opposed to just going for the lotto ticket. Because again, if the lotto ticket comes in, I might make $3,000, but I only have maybe a 20% probability. To me, that just isn't worth it. I'd rather do something a little bit smarter than that. So I try to put together trades that make sense. And I try to, I would say 90% of what I do is usually more than one leg. I think it's maybe 10% of what I do is straight calls and puts. And it's usually an event. Like if I'm expecting a very big move in one direction or another, then maybe I'll just do a straight call or a straight put. I'll use a straight put just to hedge, for instance. Like let's say I'm long a whole bunch of stuff and the market rolls over. I'll just buy SPY puts as a hedge. You know what I mean?
That's actually a good question. Do you mind if I get into that a little bit deeper? Let's actually use, let's say the market went up for 10 days in a row, just as an example. And again, just as an example, because I want to give everybody actionable stuff. Let's say you're long 1,000 shares of the SPY, just as an example. And however you look at the market, you see it slowing down, or you think whatever's going on, you think, okay, this is cool. I want to lock this in. You mentioned hedging at the beginning of the call, and now we're bringing it up again now. 1,000 shares is 10 options contracts. Would it be 10 options contracts, or would it be part of that? Again, this is all for educational purposes, but what would your thought process be on that?
Well, again, that's where delta comes in, because delta is that probability measure, right? So if you pick an out of the money put, it would actually be more than 10 contracts. Like if you do a 50 delta, in order to be 100% hedged, if you find 50 delta puts, you would actually have to buy 20 of them to be 1-for-1 hedged because of the nature of delta. So it really depends on what percentage you want to be hedged. If you want to be fully delta neutral, which isn't always a good idea, right? I mean, if you're net bullish, but you're like a little bit nervous of a pullback, you might want to just be 20 or 30% hedged, in which case what you said makes sense. You would just buy 30 delta puts and just buy 10 of them.
I know a lot of traders that do that straight up with equities, where stocks are very strong and they're heavier on the long side, but they're also paying attention to which stocks are showing relative weakness. So just using round numbers, they'll be long 1,000 or short 300 of those weak stocks. So while these things top out, then they already have a short position on in the other direction in the stocks that already had relative weakness to the market.
Yeah, you're just basically doing a short-term trade as a hedge, and then you
Exactly.
take it off once the danger has passed, right?
Exactly. That comes a little timing. You got to be good at timing on that. But if you understand how to do that, it helps you hold trades longer that you might normally have gotten shaken out of or stopped out of because you were smart enough or had the knowledge to put that hedge on.
Absolutely, and as a broader portfolio too, you don't want to get shaken out of things. Absolutely, and that's how people manage their money all the time, and it's really effective. Because even if the hedge doesn't work, then guess what? Your portfolio is going up. So
Right.
it's
I know,
kind
right?
of that's essentially what's going on. So it's a good thing.
We got a question here. I love this name. Check it out. Is his name?
Would you be able to roll credit spread like selling a naked option? Well, yeah. I mean, what you do is if you have a net credit, let's say you have let's say you do something called a bear call spread, where you have a naked call essentially, but instead of being naked, you buy something above it in order to protect yourself in case it runs up on you, right? That's called a credit spread. So what you'll do then is, let's say you take in $200 of a credit, right? And let's say today's Thursday, and today's a perfect example. Today is Thursday. Let's say it's down to $10. Are you going to risk a market moving event tomorrow just to receive $10 more? Probably not, right? So you would roll it in that case. You would close out your position and you would roll it out into another month. And that's what traders do all the time. One thing when you're trading options is you got to be very cognizant of expiration dates and when your stuff is coming off and what's in the money and what's out of the money in your portfolio. This way you could constantly add things and roll things and do stuff like you just mentioned.
I have two questions. Let's say we put on a spread. Is there any moment where you would lift the premium that you sold for a bigger gain?
You could do that if there's, what's funny is every time I've ever tried to do that, it rolled back over. It's like,
you remember the reason you put
it's,
it on in the first place?
yeah, it's like if you mess with something too much, I have a rule in my trading plan, and I don't necessarily want you guys to follow this. It's just something I kind of do for my own mental health. I'm allowed to make one adjustment.
That's interesting.
I'll allow myself to make one adjustment. So, because if I start tweaking stuff too much, you could go nuts. You know what I mean? Trying to go long, go short, trying to cover things at the right time. It just becomes like a little bit, instead of having a legitimate trading strategy, what you then have is something called an octopus, where you have like all these different legs and all these different things going on. And you're not bullish or bearish. You just have an octopus, and that's not cool. So one of the suggestions, that's a good question. One of the things you can do if you want to be more bullish, let's say something exceeds your expectations for whatever reason, it's breaking out to new highs. You didn't expect it. You kind of expected the sideways game a little bit, and it didn't happen. What you can do is just buy another call. So now you have, let's say, a 1-for-1 vertical, right? You have one call and one contract, let's say, sold against it, and then just buy another call. And then you'll have basically it's called, ratio back spread basically. So now you have one call that could do it at once. It has unlimited upside, but yet you still have that a little bit of protection on the downside with that one call that you sold.
Okay. Actually, Randy has a question here. Randy was actually part of a boot camp that we had on the stock side. Hey, Randy, thanks for coming here tonight.
Randy, what's going on? Let's see what it says here. I was a part of Pete's boot camp. Loved his method, but there was no options route like there is now. Is your approach also based on technical analysis? Oh, it is. I'm not a big math guy, believe it or not. I know it's kind of funny. I think all options geeks are these math experts. I'm definitely not. I am a total chart guy like Pete. That's why me and Pete get along so well. I look at the charts very similar. I'm a trend follower. I would say 90-something% of what I do is trend following. Once in a while, I'll stick my neck out and do a counter trend trade if something is super overbought or super oversold. You know what I mean? I will, we talk about counter trend trades also and, when they might be appropriate. But yeah, I'm a total technical analysis guy, trend follower. I use the top-down approach to come up with my sort of watch list every week. And, I make adjustments throughout the week. I don't just, I try to be as fluid and flexible as possible because obviously things change. One of the things as a trader you have to do is just know when you're wrong. You have to if you go into the market really bearish, bullish on a Monday and the market starts looking really ugly by Wednesday, you have to have the wherewithal to kind of start adding bears to your portfolio. You start adding put options and put strategies just to balance out your portfolio. And, that it's all about managing risk and managing downside. So you always want you want your losers. You have to have the psychological ability to just know when you're wrong and walk away from your losing trades. And then add trades that make sense, even in real time, like when things start to change. And that's the name of the game.
I want to hit you with a scenario that comes up all the time in our morning game plan meetings. Somebody who's brand new to the community, maybe has a little bit smaller account, a stock that hits a scan and it's got bullish order flow, but it's already up 5 days in a row. And they're like, I want to buy that option. I want to buy the option today because I think it's going to keep going. What's right or wrong about that? Without getting into the minutia of it, but it's clearly closed on the highs 5 days in a row. It's been up 5 days in a row, and they want to buy it while the volatility is at the highest.
A couple of years ago, I probably would have a big problem buying something like that. But now, sometimes you have to plug your nose and buy it. Sometimes you have to just you can't explain it. The market's going higher. And you know what? Market trends tend to continue longer than you think they do. So, you could wait for a pullback. You could wait for like a traditional, bull pullback into like a moving average or something like that. But then you might miss the trade. So that's okay. I'm okay missing a trade. But if I see the whole market moving in that kind of momentum, if I see an entire sector moving in that direction, if all those winds, think of like winds in a ship, like sails in a ship, right? If all the sails are working and all the wind is in all the sails, you got to buy it.
We've had that recently in the solar stocks where they, as a group, outperforming everything over the last 3 weeks and the last couple of days. Actually, this entire week so far, they've just been amazing. I think ENPH, if I'm not mistaken, is up something like $30 this week.
Yep. And when I say buy, by the way, I don't necessarily mean buy calls. Keep in mind, when something's up for 5 days in a row, there's a very good chance the volatility is really high. So that might be something where I'd be doing a bull put spread, where I'm doing a credit. So then all I care about then, Pete, is that it just goes a little higher. Like I'll make money if it just either stays the same or goes higher.
Very good to know. So that's a different answer than me. I actually started trading options on commodities back in 1994. So we didn't really have as much nuanced stuff. We were looking more at commitment to trader reports and stuff like that back then. But my general answer for somebody looking to buy a stock that's up 7 days in a row is that premium is really going to be inflated. You really have to believe that it's going to follow through enough to justify paying that higher premium based on the fact that it exploded for 5 days. So I kind of have a general answer, but that's why we're here tonight, to get a better answer, I guess.
Yeah, if it's a momentum play and there's a reason why that's happening, then I'd be okay, buying straight calls. But then it's a riskier trade. If it's something where you're really scratching your head and you can't figure it out and the whole market's just going higher and there's there's no rhyme or reason, maybe the market was just really oversold and it's just playing catch up or something like that, then I would be more likely to do a credit trade.
Okay. We actually got a follow-up question here from Randy. By the way, if anybody wants, John actually has an options boot camp coming up. It's 14 days. You can click the link below the video and learn more about that. Randy's saying, if you're a college student with 1.5 years of options trading experience and willing to lose a couple of grand, would you recommend your course?
Well, I wouldn't call it lose.
Yeah, don't be going that. You're going to get what you get, man. Go in, think, you got it right here.
That's very negative, Randy.
This is what's surrounding me all day.
Let's say I prefer the word invest. I think you have to spend money to make money sometimes, and that has to do with trading as well as education. So, I think that it's important to educate yourself. I think, to me, if I had the right education, I probably left thousands of dollars on the table, just doing the wrong strike prices and doing the wrong option strategies.
I think most
So
people who are willing to invest in themselves never focus on what it's costing. They focus more on, do I believe this will give me ROI, and how fast? How fast can I make my money back if I make this investment? And then I'll put that into the next thing to level up. I think far too
yeah,
many people think about the cost. Now, again, obviously, with respect to everybody and how much they can invest in themselves. But if you can, in an opportunity, the first thing should be, will this pay for itself? How fast do I believe this will work for me?
absolutely.
Then it's a IQ test at that point. If you believe it'll work and you have the money, then it's a no brainer at that point. It's not about the cost. It's about now you have that skill for the rest of your life. Actually, that's how I see
Yeah,
everything. I invest a lot of money in myself.
yeah, that's how I look at it too. I think that investing in yourself is important. If you really want to master options, the most important thing to master is not just obviously the math behind it, the Greeks and all that stuff. It's really strategy selection and when to use it, and why, and how. That's what kind of separates a professional from someone who's just out there buying calls and puts and kind of speculating on things. Because I know plenty of options traders that have been really frustrated with their results because they just, they do some more simple strategies, out of the money calls, out of the money puts, and sometimes they make a lot of money, which is great if they're right exactly at the right time and they're perfect. But that only happens maybe 2 out of 10 times. And that,
I
to
don't like
me,
those odds.
yeah, to me, options, trading is very, stocks are similar to, it's a probability game. You want the odds to be in your favor, but most traders don't really have a very high winning percentage. Most professional traders, their winning percentage is not something you would put on the refrigerator and show your mom back in school. You know what I mean? Like, if you have like a 60 something percent winning percentage in trading, that's pretty darn good. As long as you manage your risk. As long as the down doesn't destroy your winners. And that's the key to good options trading. Like, putting these debit strategies together, exactly how much you're putting on the table. You know exactly how much you're risking. And if it's $500, it's $500. If it's $300, it's $300. You know exactly what it is. So that's the key. Always think of the downside first.
I think that is the difference between, and again, whether you quit your job or not, I'll say professional, is the depth of managing the downside first. Because look, let's face it, if you got the downside managed, one of the things that a lot of people fail to put into the equation is you have to give yourself a chance to learn. And if you're blowing your account up and refunding it, blowing your account up and refunding it, you're not actually getting experience. So there's nothing wrong with dialing back the amount of risk that you're putting into the idea to learn to make better decisions. Because if you manage the downside, you'll be around long enough to learn how to make more when some of those ideas follow through and put yourself into better positions.
Absolutely. 100%. The key is always managing the downside. And, I tell my students that the money shows up. If you manage the downside, I can't guarantee how profitable you'll be or what you'll make and how much you'll make, who knows, but the money starts showing up once you manage the downside.
Yeah. You'll be surprised also how lucky you get when you're putting in that work and a few trades follow through. We actually had something the other day that we were talking about in the community. I think it's a really big misconception, and I'm actually glad you just brought it up, that for some reason people think that professional traders never have losing trades. What I've been doing in the community a lot recently, especially after the morning or the end of the day, I've been saying I made 7 trades today. 5 of them did not make money, but I was profitable today.
Yeah.
So again, managing the downside and learning how and when to either size up or hold longer. It's really, honestly, it's about managing risk and learning how to make more in the good trades.
Yeah, that's another thing too. That's another thing you just touched on. In the options market, you can also size up, right? You can start with a half position. I call them units, risk unit, right? If let's say your maximum risk is X, you start your option strategy with maybe half of that. And then as the trade starts to work, what you're doing is you're building equity capital in the trade, right? You have an actual, let's say, a profitable trade going on. Then you could start adding to it. And that's something that is really effective, especially with options, because you can add on things very quickly.
What you mentioned before, vertical versus diagonal spreads. What's the difference between the two?
Well, the diagonal spread is one of my favorite strategies. It really is, because it kind of combines both ideas. So when you have a straight call, a call is basically the most aggressive strategy. You're long a stop. You're long an option. You're bullish. Obviously, you're very bullish. You have a massive target on it because you think it's going to just rip higher because you didn't sell anything against it. So that's one strategy, right? A vertical spread is more conservative because you're picking a call option, let's say out 30 days, and then you're selling a call option against it for the same expiration date out 30 days. So for that 30-day period, you're capping your upside, basically, like we talked about. You have you have something that you have a sale option on top of it, which basically caps whatever that is. So if you buy 100 strike call and you sell 110 strike call against it, if it goes to 111, you don't make that extra dollar because you're short a call essentially at 110. Now, a diagonal spread, what that does is it allows you to test drive the call option. That's what I like to call it. It's like the option test drive, because what you're doing is you're not using the same expiration date. What you'll do is you will go out a month just like you normally would. Let's say you buy a 1 month call option, right? The $100 call option. And now what you'll do is you'll say, you know what? I think it's going to go sideways this week. I think it's eventually going to break out. But, this week I'm a little bit more bearish. I think the market's kind of tired, but you still like this particular stock, right? That's your problem. That's your dilemma, right? So what you do is instead of going out a month on the sell side, you just go out a week. So what you'll do is you have the 1 month option, which is your main leg or your anchor leg. And then what you do is then you go out a week, and let's say instead of the 120s, instead of the 110s, maybe do 105, because you don't expect it to really move around too much this week. Now, here's the good thing about this. You go out to you do the 105s out to this Friday. When Friday comes along, and let's say it's at 104.5, that option is going to expire worthless. You took in a very small credit. You didn't take in a larger credit like you normally would if you went out a month, because of time decay, right? There's less time. But now what you can do is you could roll it up. If it's at 104.5, you're no longer going to sell a 105 strike. Now you're going to do the 110s for the following Friday. And then let's say next Friday rolls around, you could do the 115s. And let's say the following Friday rolls around, you could do the 120s, and on and on and on. And what you're doing is you're just rolling up your short calls and you're collecting a premium every single week. And what you're essentially doing is you're lowering the cost of your trade. If that original 100 strike cost you $500 and you're taking in $50 to $100 a week in credit, now your trade is essentially free. And now, worst case scenario, the stock goes to 110 on Friday, right? You're still going to have a profitable trade because your anchor leg is still the 100s. You're still going to have a profitable trade. Only thing is you won't make as much money as you wanted to. You would have to close out that position. Maybe you're only up 10, 20% on the contract. Who knows? But I could think of worse problems to have than be up 10, 20%.
No, right? Yeah. Actually, it looks like Philip had a good trade that he got out of too soon. $20 puts when the market went down, went up to $800 a couple of weeks ago. Sold too early. Better get out now. Who's going to buy this? So who's buying such an expensive put when the market can't even catch a bid? Then he says,
what? I never really worry about that. A lot of people, I've had people ask me that before, like, oh, who's on the other side of the trade? I don't care. You know what I mean? Like, it's good to know, it's good to look at volume and open interest to see, to see where institutions might be hedging and what's going on. But there's really no rhyme or reason sometimes why someone would take the other side. It could just be a market maker trying to make the spread. Who knows? It could be a hedge fund maybe hedging a position. It could be someone doing something else, part of a larger trade something more complicated that you have no idea what's going on, right? So I never really let that bother me. You know what I mean? Like if someone wants to buy a put that's that expensive, that's on them. You know what I mean? They might just be hedging, or they might just have a more bearish stance than you. Who knows?
So we're going to get to a question from Lou here in a second, but we're going to throw in a 15-second commercial.
Oh, okay.
So, John, you have your options boot camp starting next Monday. Who should sign up for that?
As far as who should sign up, I would say there's different groups of people. First of all, if you know absolutely nothing about options at all, you could definitely sign up for this. It's something where a lot of the recordings, and I go step by step on the basics. I cover all of the basic option language, the jargon, and everything else, including the Greeks. And even someone who has limited experience trading options, they should go through that boot camp because there are going to be things they don't know. There'll be certain concepts that they might have heard of, but they might need some review, or they might need to know the real definitions of what real things are, right? So if you have zero experience or limited experience, I highly encourage it. Now, if you have, let's say you're somewhat of a novice, you've been trading maybe a couple of months or a couple of years even, but you want to up your game. This is going to be for you too, because we do start covering multi-leg strategies in the boot camp, in the Discord channel, which you'll have access to, I believe, the second week. We give trade alerts and we discuss them. So there are for people who want to up their game from maybe doing single leg strategies to more complex strategies like the diagonal that we just talked about, or the verticals and the credit spreads. All that's going to be in the Discord, and we'll cover debit and credit spreads in the boot camp as well. So there's definitely those are the kind of people. Now, if you're super advanced, let's say you know what verticals are, you've done them, you've been doing this for 5-10 years, and you really want to start doing let's say you want to start doing gamma strategies and iron condors, and you want to start doing targeted butterflies and all these 3 and 4 leg option strategies. We cover that in a more advanced session in the annual membership as well. So I think the boot camp is a great starting tool for everybody. That's kind of how I look at it.
Costs less than one trade too. For $195, it's an investment to get started the right way, I think.
Absolutely.
Got a question here from Lou.
So if I'm looking at a straight call or put trade, do you tend to buy at the money or deep in the money? More of a stock replacement strategy? Lou, that is an excellent question. And that really depends on volatility. So am I doing something more of so let's talk about stock replacement strategy. If you believe a stock is going up, but it's going to go up in a sleepy, slow kind of way, let's say a slow drift higher, you know what I mean? Like the market's just drifting higher, we're in an uptrend. You're looking at a stock. There's not going to be any kind of volatility. There's not going to be any earnings or any kind of news. You could do something that's in the money, and you're kind of just using that stock replacement strategy basically. And you could still, by the way, Lou, you could still sell calls against those options as well, and bring in some income while you kind of wait for that appreciation to happen, right? And what I would do for that is I would obviously go out more than just 1 month. I would go out maybe 3 months or 6 months or something like that, because essentially you're buying the stock. That's kind of like what you're trying to replace the stock with. So for an at the money strategy, that you want to take advantage of volatility. That's the main difference. An at the money strategy, you're going to want to take advantage of not just the uptrend of the stock, but you're expecting some sort of increase in acceleration, and that would be the main difference between the two.
Okay, we've got a question from Bernardo about risk.
Bernardo, what is a good percentage risk in options, and how do you put it when you buy the option contract? That's a great question. So there's different ways to manage risk, which we talk about in our class and in the boot camp as well. So managing risk, there's different ways of doing it. First, you got to determine what your risk unit is. So I talk about what a risk unit means. It's basically how much you're willing to risk dollar-wise, and then you kind of back into that number and figure out your contracts. But what you have to do is figure out how aggressive you want to be. So for instance, I'm going to give you an extreme example, and I'm going to give you like a normal example. If you're betting on something happening like a momentum trade, let's say there's a news event or an earnings play that you want to do, or something where you're banking on a very specific move at a very specific time, and it's going to happen very quickly. That is something you need to be really small on, because you have to assume you're either going to be a zero or a hero. That's what I like to call people, right? I mean, because basically your option is either going to blow up, or you're going to make a lot of money because it's going to go in the right, it's going to go in the direction that you think. So I don't like doing trades like that. That's like an earnings, like if you're trying to play the earnings coin flip and all that kind of stuff, and you think it's going to move and you're bullish or bearish. That's cool, but that you should be doing a quarter risk unit. So in other words, if you're willing to risk, let's say $1,000, I would be only looking to spend about between $200 and $400. And if it goes to zero, no big deal. You know what I mean? That's one way of doing it, right? That's the more extreme way if it's like an event, right? Under normal conditions, just so you know, I look at things like ATR, the average true range of a stock. That usually represents, give or take, between 20 and 40% of an option premium. So if something moves one ATR against you, you're probably going to lose 20 to 40% of your option, especially if it's less than a month out. So that's a good guideline. So I kind of like to hold things for like 50%. That's usually what I like to do. That's been kind of my wheelhouse. So if I'm willing to risk $1,000, let's say, that means that I could buy a $2,000 option, let's say, a $2,000 strategy, let's call it. If it goes down to 1,000, I'm gone. That's kind of how I look at it. You could also leave conditional orders, but the problem with conditional orders is, basically you're relying on the underlying to tell you when to get out, right? And then you have no clue what your premium is going to be when that happens. So some traders like to use conditional orders. If you're just doing straight calls and puts, a conditional order might be appropriate. But again, you're not going to know when you're getting out then. You're not going to be able to manage it as good. So I always prefer percentages. That's just kind of my personal taste. But those are the main ways you can kind of manage your risk.
What are your thoughts on new options traders selling naked options?
Very bad. A naked call is very bad. Unless you have a lot of money in your account, that's a synthetic short position, right? So anything could happen overnight. When you sell a naked put, you want to be happy owning whatever it is you're selling naked. So think about that. If you sell one contract of let's say, where's Tesla trading these days? If you sell
270 or something like that.
Yeah. So if you sell a naked put on Tesla, 289, I think. Yeah. So let's say you sell the 275 puts, right? You think it's not going to go down to 275. If you get it signed, you're tying up $27,500 to what? Make $300? It doesn't make sense. So that's the thing. If you do a strategy like that, just do a credit spread where you, let's say, sell the 275s and you buy the 270s. Maybe you only take in $150, but then you could sleep at night. You know what I mean? And that's the key. So these are all things we'll learn in class, but I think any kind of naked strategy for a newbie, even for an old bee, is not a good idea. That's just my 2 cents.
Probably a complicated question, but intrinsic value in options. Can you give a quick update, explainer on that?
Yeah, that's one of the very first things we touch on in our class, because it's very important to know moneyness. So in the money options have intrinsic value. So basically the strike price is lower for a call. It will be lower than the current price. So what you're doing is, when you're buying an option that's in the money, you have a coupon that says, hey, I have the right to buy this at a cheaper price than where it's trading. That's an in the money option, right? So if something's trading at $200 and you have a 190 strike call option, your intrinsic value is $10, because there's no such thing as a free lunch, right? No one in their right mind is going to trade that for less than $10, because that's what it's worth. You have the right to do something at 190 that is trading at 200 right now. So that's all intrinsic value is. It's the absolute value of that coupon you're buying, right? Now, if you're buying something that's at the money, if you buy the $200 call option and it's trading at $200, your intrinsic value is zero. So that option's not going to trade at zero. there's still some idea where you have volatility and time in there. Those are the other components of the Greeks that go into option pricing. So you might pay $2 and I don't know, you might pay $2.05 for an at the money option, right? So that $5 is extrinsic value. I like to call that the smoke and mirrors. That's that's the volatility and time component. So every option has two components, intrinsic and extrinsic. Sometimes it's zero for intrinsic, but then there's always extrinsic until you reach expiration. At the very moment of expiration, when the option's about to go to heaven and die, right? All is left is intrinsic value. Or zero.
Our terminology here today. This is awesome.
Yep.
Let's see. Doesn't look like we have. Oh, wait, one more question here from Sean. Oh, very good question.
Oh boy, more of a swing trader, definitely, Sean. But there are scalping and day trading strategies for options. Personally, I don't necessarily day trade individual stocks on options on stocks as a scalping mechanism, because usually spreads are too wide. So if you're going to scalp or day trade options, all the traders that I know that day trade options, they just trade SPY, QQQ, or SPX. They just trade that because they're just trading direction and momentum, right? Unless it's like and again, there's always exceptions. I mean, if there's an event, you're obviously going to trade the event, right? So that's like if there's earnings or you're trading about something called a volatility crush, which we'll talk about in some of our coaching calls. Once the cat is out of the bag, the volatility of the option decreases. So if there's an event where there's going to be a big news event like earnings, right? Once the news comes out, everybody knows what's going on. The volatility crushes. So a lot of people play that trade as well. So that's a day trade. So those are strategies where, an individual stock you would do, but for the most part, I swing trade. If I look, like I said, I'm a trend follower. So I'll tend to have a mix of bulls and bears at the same time, depending on what sectors are doing well and which sectors are doing terrible, and what my overall idea of the stock market is. So right now I'm leaning towards bearish, even though we had a couple of good days. So I'm using this opportunity the last couple of days to add a couple of bears. We'll see. And if I'm wrong, which I could be, I have no idea if I'm going to be right or not. If the market continues to drift higher, I'll just add bulls and I'll naturally get stopped out of those bears that I just mentioned. That's kind of how every day I kind of just reevaluate.
I think it's a good question by Sean. In my experience, I think most people want to trade options, so they're not at their screen all day, whether it's a week out, a month out, or letting the position unfold, between whenever they buy it and sell it in expiration.
The trick
that's my experience. I think most
trading.
people don't want to be at the screen, but that's a good question.
Yeah. No, swing trading is, option swing trading is great if you're kind of like, if you have a full-time job or you're kind of busy during the day and you can't kind of watch your screens. It's a great strategy. It's a great way to kind of let things go in the background. You know what I mean? Also, if you are day trading options in the sense that you're watching it every day, really what you're doing is portfolio management. You have a basket of like maybe 10, 15 things going on at once. And you have to manage that every day in the sense that, okay, should I add some bulls? Should I add some bears? Should I lighten up on a position? Should I add more of whatever it is I'm doing because it's doing well? Those are the decisions intraday that you make as an options trader when you're swing trading. You're still gonna be hands-on in that sense. If you're an active trader.
See, Lou has a follow-up.
Do you do any zero options trade on the indexes? I'd be lying to you if I told you I never did those, but they usually don't work out very well. I always try to, when I do an index option, I try to give myself at least a day or two. I know they're more expensive, but I just feel that doing that it just goes to zero so damn fast. So, because you have literally one day to either make it or break it, So that's something, the index options, I'll give myself a couple of days if I'm scalping or day trading with the intention of getting out of it that day.
Okay. Follow up from Randy here, teaching live or recordings. Randy, I could actually answer this. It's both, actually. the way all the boot camps are structured, and we've had a ton of experience with this now over the last couple of years, it's the core strategies are recorded, and then we have live implementation sessions and live coaching sessions, which are follow-up questions from the course. It's best that it's not taught over and over and over again. You'll have access to watch the videos and then come to the coaching sessions and the implementation sessions to ask questions that are deeper than just what you saw in the video. We found that it's by far the best way for people to get up to speed quickly.
Absolutely.
Let's see. Rob.
When hedge funds enter options, how much % profit are they aiming for? Well, that depends on each hedge fund. Usually, it really depends on what their individual situation might be. A hedge fund might be using options just to hedge, in which case they're not really looking to do anything. They're just looking to protect themselves. But usually, what a hedge fund, if let's say a hedge fund is doing like an activist kind of thing, like the dudes that you see on television on CNBC, the Carl Icahns of the world and those kind of people, they'll use the option market as a way to increase their position without letting the whole world know. So they'll oftentimes load up on options, around maybe a board meeting or around some sort of vote or something like that.
I've seen a lot of prop traders do that, where they have their equity allocation to an idea, but if everything is lining up, they'll leverage in with options on those same ideas.
Yeah,
rare, but that's when it's done.
And 9 times out of 10, they'll already be making money on that trade. So they're, if let's say they have an equity position in a stock and they've held it for a long time, for whatever reason, they're really bullish on it, or they're trying to maybe take it over, or manipulate the board or something like that. They might be making millions of dollars on that trade already. So what's a couple of $100,000 to them in options that could like maybe double their profit, because they're just putting on so much leverage.
Yeah, it's so funny you say that, because a lot of what we talk about during the day too is we use that first hour of the day from the day trading perspective to try and get a head start on the day, and then the real trend of the day starts to unfold. And those trades you take after 10:30, or if you're swing trading, let's say Tuesday through Friday, when you already have some P&L in the bank, your level of conviction and aggressiveness, it does get a little bit higher when you already got that money in the bank.
Absolutely. It's good to, it's a good feeling, but then again, you got to be careful, because if you have a lot of profitable days in a row, if you look at your odds, that's when you should be maybe taking some off, right? So
yeah, I can tell you early in my career, my biggest losses were always after my biggest hot streaks.
That's not uncommon, man. That happens a lot. And I don't know if it's mental or if it's just the law of averages. It might be a little bit of both,
Mm-hmm. All right, I think we're going to call it a night, everybody. You've got about an hour of Q&A in here. John, thank you so much for your time. I really, really appreciate it.
My pleasure.
If you don't know, obviously John is our options trading pro in our community. Very grateful to have him. If you want to learn about his boot camp next week, only $195. Click the link below. If you have any questions, email our support staff. We'll be more than happy to answer any questions that you have. So have a great night, everybody, and we'll speak to you soon.
Have a good night, everybody.
Take care now.
Take care.